Hello all, we are going to get started today. Hopefully you can hear me. Hopefully somebody pops a note into the questions. All right, sounds like I'm good. Welcome and thank you for joining us today for our lunch presentation. We always want to keep you updated, informed, and share best practices with you. So today's topic is New York State sales tax for construction contractors. How is everyone doing? Hopefully you have your lunch, coffee, and we're going to keep this to an hour today. So let's get going. Today's presentation, we are going to explore the definitions of contractors, review tangible personal property versus real property, government and exempt entities, and some other consideration. We'll save time at the end for Q&A. I'm Carolyn Powell, the Development Director here at Tronconi Segar & Associates. I'm going to be your host today. A couple things that we'll do from a housekeeping standpoint. If you've been on our webinars, you already know this, but there is a toolbar to the right of your screen, and you should see a couple things there. There's a question section. You can submit questions at any time. We'll get them answered for you throughout the presentation or at the end. Also, too, there's a section of handouts. Go in there, there's a copy of the presentation. There's also bio of our experts today and a couple other things in there for you. At the end of today's webinar, there will be an exit survey. If you could please complete that for us. Let us know how we did. If you need to follow up with some additional questions that you might have, if you could complete the exit survey. And then this afternoon, I will send you a link to the recorded session. Again, another copy of today's presentation if you want to go back and listen to anything, or if you want to share it with somebody else. So let's get started. Today's presenters are Tom and Kaitlin. Tom is a CPA with over 20 years in public accounting, broad range of industry experience, manufacturing, food, financial services, electronic commerce, environmental, software. Tom's kind of touched them all, so he'll be able to give you some good insight today. And Kaitlin is also a CPA. She worked for New York State Department of Tax and Finance for over 15 years as a tax auditor. So she brings another insight into this, and now she is a tax manager here at the firm, specializing in our state and local tax department. So before we get started, I'm going to do a quick poll so that our experts can get to know you a little bit more and what your background is. So let's select the first question. Let me get it launched. So the question is, are you collecting ST-124 certificates from your customers for capital improvement projects? Hopefully it's yes. There might be some no's, or you might be saying, like me, what is an ST-124? So Kaitlin, where do you think this is going to come in at? What percentage will you give to how many people are already doing it?
I really hope the answer is 100% yes.
All right. All right, I'm going to close this out in 3, 2, 1, and I'll just share with the group. So we have 71% yes. There's a couple sitting with me, 18% that have no idea, but that's okay. We're going to educate them. So Tom, I'm going to hand it over to you to get them started and share all this information.
Thanks, Carolyn. Good afternoon, everyone. Thanks for joining us for this webinar. I think Carolyn briefly mentioned some of the topics we're going to cover today, including contractors, like just the general definition. And then Kaitlin's going to talk a little bit about tangible personal property versus real property. And I think we're going to go back and forth. I'm going to do some capital improvements, and she's going to talk about leasehold improvements and repairs to real property. And I'm going to kind of bring it all home, talking about some issues contractors typically have with government agencies or entities and exempt organizations, as well as a couple other quirky issues that we see from time to time. So let's get started. Okay.
Sorry.
So just some general definitions so you kind of have a level playing field of what we're talking about today. Really, what we're talking about are construction contractors, and that differs from somebody who registers in the state and gets their certificate of authority and is considered a vendor. A vendor is someone who might sell taxable, tangible personal property or services. The construction contractor really is someone who works on a construction contract. And that is defined by New York State as any type of contract where you're building, repairing, maintaining a structure, a project, or any other type of improvement on real property or land. So that's generally what a construction contract is. And then a contractor is someone who literally works on that. And that could be, a prime contractor or a general contractor, the subcontractor, or some type of repairman or a person who does installations. So on the next slide, talk about contractors and whether or not they should register for sales tax purposes. Not necessarily have to, unless you're in the business of making taxable sales, performing taxable services, or you want to issue exempt documentation such as ST 120.1, which we're going to talk about. Otherwise, a contractor really doesn't need to register unless they're making taxable sales, which would include any type of repair and maintenance of tangible personal property, or any type of repair and maintenance of real property. And we included the link below to the licensing center in New York in case you are not registered and think you need to after this. Okay. So we talked about contractors, and one of the other reasons a contractor would not need to register for a certificate of authority is contractors pay sales tax on all the materials that they purchase. So there's no using a resale certificate, an ST 120, as a vendor would. If I own a retail store, I buy my inventory, I issue an ST 120 resale certificate, and that manufacturer or distributor doesn't charge me tax because I'm going to in turn charge tax to my customer when I sell that property. Contractors are in a different bucket. Contractors are really considered the consumer or the user of the tangible personal property which they purchase. And that's anything from tools and supplies to actual building materials that are going to be, installed as part of a construction project and become part of the real property. So contractors like that said are a little different. It's not like you'd be accruing use tax on any purchases that didn't have tax on them because you have to pay tax, at the time of purchase on that stuff. And then with contractors are a little different then too, in a sense that they pass through their material costs to their customer. So when you're calculating how much to charge a customer, you can include the sales tax you then paid on the materials, as well as any markup on your invoice or your bill to that customer. So it's a little different. There's no resale. You consume that property, you pass that tax through to your customer as an expense on your invoice. You may not charge the sales tax, like in the case of a capital improvement, which we'll see, but you kind of recover the cost of the tax that you paid through this process. So I think that's just some general information we wanted to share on contractors. And I'm going to hand it over to Kaitlin to talk a little bit more about what's tangible personal property versus what's real property.
Thanks, Tom. So now that we have defined contractors and briefly touched on general rules for when contractors should be charging tax, the next step is to differentiate between what is tangible personal property versus real property. And the reason is because there are different rules for each. So tangible personal property, or TPP, is items that can be physically touched. Some examples would be tools, materials, supplies, vehicles. New York State imposes tax on the sale of services of installation of TPP, as well as repair and maintenance of TPP. Here are some examples of TPP that retains its identity as TPP after installation. Some common ones that you might see would be freestanding appliances, freestanding cabinets, etc. A good way to think about it would be items that can be removed easily. Here's some examples of situations where the item is tangible personal property and the service being performed to it is taxable. So in the first one, the customer is having a washer and dryer installed in their home. This installation would be taxable. And then in the second example, a customer is having an alarm system that's in their home repaired. And because the alarm system retains its identity as tangible personal property after it's installed, any repair and maintenance that's done to that property after the fact is still taxable as a charge for repairing TPP. I wanted to point out that there is an exemption for installations of TPP and repair and maintenance to TPP being taxable. And that would be if the TPP is production equipment. So if the production equipment qualifies for the exemption, which means it's directly and predominantly used in production, then the installation of it or the repair and maintenance of it is exempt as well. As a contractor, it's not your job to police whether the equipment does or doesn't qualify for the exemption, but what you would do to substantiate is you would collect Form ST-121 exempt use certificate from your customer, and that is them certifying to you that the equipment qualifies for the exemption. Okay, so real property. Real property includes land, buildings, structures, and then building systems. So a building system would be like the HVAC system or the plumbing that runs through the building or underground, and then the electrical system, for example. Items that are affixed to the real property that become part of the real property are also included in the definition of real property. So in New York State, tax is not imposed on the charge for installing and repairing, installing TPP, which becomes a permanent part of the real property. But charges for repairing or maintenance of real property are taxable. So some examples would be cleaning, pest control, landscaping, that type of thing.
Okay. Thanks, Kaitlin, for that discussion between TPP and real property. Going to talk a little bit about capital improvements, construction work. New York has its own terminology regarding, construction and what qualifies as real property. We call it capital improvements. Not every state uses the same terminology as New York. There's really only a couple that I can think of, like West Virginia, New Jersey. Not everyone else really has a call out of a capital improvement. Most states just say it's construction. Construction work would be not taxable. And then they have their own rules related to, repairs and maintenance of real property. Some states don't tax those repairs. New York, of course does. So the construction is non-taxable, as Kaitlin said, when it comes to real property, if the end result's a capital improvement. And a capital improvement means an addition or alteration, which does three things. We have this three-pronged test. The property being installed has to substantially add value to the real property or appreciably prolong the useful life of the property. The property, the stuff that becomes part of the real property or is permanently affixed, so much so that if you try to remove it, it would cause material damage to the property or the article you're trying to remove. And then the third prong is it's intended to be a permanent installation. And what we see most of the time with the three-prong test, you can usually argue pretty successfully, yeah, it's adding value to the real property. You can show that, hey, if I try to remove, this ductwork or this electrical, it's going to render the electrical, wiring useless, or it's going to damage the property itself and have a huge hole in my wall. The intention of permanence is where I think the state likes to really trip up people, and we'll see that when Kaitlin talks about leasehold improvements a little further along in the presentation. So on the next slide, we just have a couple, sorry, I got one ahead of myself here. So I think as Kaitlin said, we don't charge tax as a contractor on a sale of a capital improvement, work that results in a capital improvement. It's not subject to tax, but at the same time, in order to prove that to the state, you have to get what we call an ST-124, a certificate of capital improvement from your customer. And the customer would just fill out this form. It's pretty easy form. It's only one page. It just identifies the contractor, the customer, brief description of the work that's being done, the location of the work being done, and then there's some certifications as to whether you're not the owner or the tenant and what you're actually purchasing. The customer signs it, and then the contractor themselves signs it. It's imperative if you're a contractor and you're doing work that results in a capital improvement that you get these forms from your customers, because I've had issues before with audits where we've had a contractor in the plumbing business did not get any ST-124s from any of their customers. The auditor in that instance was nice enough to let us go back and get a sample of certificates, but it was a lot of work for the contractor reaching out and connecting with, customers to try to get these forms completed and back to us so we could provide to the auditor. So, your best defense for something like that is just getting that done right away, making it part, of the billing or closing or signing the contract with that customer. So just a quick example, we put a couple quick examples in here with the billing that we talked about. So in this example, a contractor is hired to build a new porch. That installation of that porch qualifies as a capital improvement. The contractor had to purchase about $500 of materials, including lumber, screws, stain. So the contractor is going to buy those materials, that $500 worth of materials, and he has to pay 8% sales tax. So he's going to, pay $540 on the cost of the materials. Then when the contractor turns around and bills his customer, he's going to charge $600 for the materials, including the sales tax and a nice little markup on it, and then $1,000 for the labor. So the invoice to the customer who provided the ST-124 is going to be $1,600. So we passed along that sales tax that we paid on the materials as part of our expense on the project to the customer. We don't bill any additional sales tax in the case of a capital improvement. So what I wanted to do is just kind of give some general examples of capital improvements. And the state has a great guidebook. It's been around forever, publication 862, which discusses, what's considered a capital improvement and what's considered repairs to real property. Has some nice general information in the beginning that's pretty valuable, kind of explains, purchases of materials and what you would tax and not tax as to regard to your services. And then it has an extensive list of everything you could possibly think of that a contractor would do service-wise, and what would be considered a capital improvement and what would be considered a repair. It's a really great book that we use around here all the time. So, generally speaking, like air conditioning, right? So the installation of a central air conditioning system, as well as all the duct work that needs to be installed throughout the building, that would be a capital improvement as well as, any complete replacement. You're going to see that terminology a lot in publication 862. If they talk about a complete replacement of something, that's typically going to be a capital improvement. Otherwise, the repairs, the replace, that is usually typically going to be something taxable. So it has to be a complete replacement. Otherwise, if you're just replacing, a controller or piping or a section of piping or something like that, that's going to be taxable repair. And then we also had driveways, parking lots, and walks on here. The installation or a complete repaving, a resurface of a parking lot, for example, that's going to be considered capital improvement. The original striping of a parking lot would be considered capital improvement, but if you looked at a restripe, a couple years later, a parking lot needs to be restriped, then that's always going to be a taxable repair and maintenance. And the same thing with the air conditioning. If it's it has to be through the wall. If it's a through the wall unit, exempt. If it's just a window unit, that's just got to be a taxable installation, a TPP. Because you can just remove that pretty easily, if you need to. So electrical, electrical too, same kind of thing. Any complete wiring or rewiring of a structure, or you have to upgrade the wiring, for service purposes, that's going to be exempt. New circuits, any in-wall installations of wiring, communication cables for, burglar systems, security systems. The only time that really wouldn't be, that those type of cables wouldn't be a capital improvement if it's provided by the phone company or a cable company, to provide their service. And these days, don't have too many people installing new phone lines or cable lines. Everything's streaming or digital these days. So that's kind of gone by the wayside. The installation of computer cabling, digital, fiber, coaxial, that's still being used. That's all going to be considered capital improvement too, as well as just, your typical circuit breakers, outlets, receptacles, switches, that type of stuff is going to be considered a capital improvement, if you're an electrician. On the plumbing side, same thing. The addition to a piping system, if you have to excavate, your front yard to completely replace, your sewer line or your piping system, the excavation work would be considered part of the capital improvement project. Any type of, complete installation or replacement of a garbage disposal, a sprinkler system, water pump, all that would be, definitely considered capital improvement. If you're just repairing your sink, you're putting a new faucet on, that's taxable. If you're unclogging your drains, that's going to be a taxable, repair or maintenance service as well. Floor and floor coverings. This is there's a couple different areas with New York that get a little tricky. Floor and floor coverings, painting, those are a little bit difficult for these purposes. And we just actually went through that here. We just had a little renovation of our office space, and we put new carpet tile down, replacing the existing carpet. We did some repainting, that kind of stuff just to freshen things up. And with floors and floor covering, there's two things you really need to look at. If it's a floor covering, if it's a carpet, if it's vinyl tile, if it's carpet tile, it's an exempt capital improvement as long as it's the installation of the initial floor covering, right? So you build a building, you put that, carpet down throughout the building, then it's a capital improvement, as long as you do within like 6 months or so. But 10 years later, like we did, we went through and we put new carpet tile down. Well, that's going to be taxable because it's not the initial, finished floor covering. So you got to be careful about something like that. But then there's a difference if you're talking about flooring, a floor like a wood floor, wood laminate, ceramic tile, the initial installation of that would be a capital improvement. And then if you actually went back and said, oh, I don't like this wood floor, I'm gonna put ceramic tile down, and you ripped out that whole wood floor and put the ceramic in, that would also be a capital improvement. So there's a difference between flooring and floor covering that you need to think about. And then any initial, cleaning, sanding, waterproofing, painting, staining, that would all be a capital improvement as long as it's the initial time you're doing it, not down the road. Otherwise, that's repair and maintenance. Roofing's another fun one. The complete replacement of a roof of an entire building is a capital improvement. But also, if you're just doing maybe you're doing a complete side of a peaked roof, or you're, re-roofing the dormer that you put in at your house, or a turret if you live in a castle, I guess, and are putting a new roof on the turret part of your castle. That's actually in the state's, publication 862. As long as it's a complete section, a whole part, then it would be a capital improvement. If you're just replacing a few shingles and whatnot, repair and maintenance. Same thing with the installation or replacement of gutter or downspout system. Kaitlin, that's a question I guess I would have for you. If I'm only doing maybe the front downspouts and gutters in my house, would you guys consider that a capital improvement, or it has to be the whole house?
It's kind of a tough question. There are several services like that where it kind of depends on the extent of the work being performed. And unfortunately, there's not really anything that defines the extent between what is a repair and what is a capital improvement. So sometimes it's kind of just, it depends on like the amount of work that went into the job. Perhaps the dollar amount could also be considered. I guess, unfortunately, there's not really one right answer there.
Okay.
I think it could go either way.
Okay. Yeah, there's a lot of cases like that where it might depend on the auditor or the extent of the work being done, whether it would be considered a capital improvement or not. Landscaping and yard work is another tricky area. Landscapers are contractors. I think that's one thing that I've, learned to tell a lot of my clients over the years. You're not a vendor if you're a landscaper. You are a contractor. And the same rules that, apply to you that, folks who build a house. Any type of installation of a fence, a permanent fence, patio block walks, gates, lawns, retaining walls, underground sprinkler systems, that's all considered a capital improvement. Planting or replacing perennials, not annuals, but perennials, shrubs and trees, that initial installation, that's got to be a capital improvement as well. I had just had that last summer. My mother had a guy come out and, remove one of her trees that was dying in the front yard, and got the invoice from the guy, and he's not charging a sales tax. And I got into a whole thing with them saying, well, you got to charge sales tax. You're removing the tree and you're not, installing a new one. You're just restoring the land to its original condition. That's a repair. My mother's looking at me like, shut up, he's going to charge me more. And I think the reason he wasn't charging tax was he wasn't registered, but that's a whole other story. But, you got to be careful with that when you are, in the business of landscaping, mowing, any work like that, maintenance, pesticide, that's all taxable. Installation of annuals, like I said, that would be taxable as well. So got to be careful on the landscaping end.
I'm sure that guy was not ready for you to come out.
No, he didn't think he was going to be dealing with a sales tax expert, I guess, that day, who wanted him to charge more money. And then finally, just some miscellaneous items, asbestos removal. If you're, have an old building maybe that you're, updating or remodeling or restoring, just removing asbestos alone, that's going to be taxable repair and maintenance. It has to be part of a bigger capital improvement type project. what the end result. The end result's a capital improvement, that asbestos removal, will be taxable. Same thing goes for like if you're in the business of operating a service station. If you're pulling out the underground tanks and everything, and okay, well, maybe you're going to build a convenience store there now or something else, that could be considered capital improvement. But if you're just pulling that tank out and not doing anything, that's just restoring the land to its original condition. And that would be a repair job. We did a lot of work for some environmental remediation contractors, and that was a big argument we would have all the time, that you're not doing a capital improvement just by pulling those tanks out or whatnot. It's has to be part of a bigger project. Painting, like I said, kind of like floor covering, the initial painting of a structure or an addition or something like that, that's got to be a capital improvement. But 3 years later, you want to repaint or it needs touching up, that's all taxable. So you need to be very careful with things like that. So that's kind of my talk on capital improvements. Hopefully gave you some good examples of what qualifies as an exempt capital improvement versus taxable repairs and maintenance. And I'm going to hand it over to Kaitlin to talk about leasehold improvements, which could be a real beast of them on themselves there.
Thanks, Tom. Okay, so now that we've covered capital improvements and we know that those are exempt, we're going to discuss what happens if the capital improvement work is performed on leased property. Basically, the TSBM that's listed on the slide here established that any additions to real property are going to be default presumed to be temporary unless we can prove to the contrary. So where we should look for this is in the lease agreement. There's wording in the lease agreement that could be used to support permanence, or sometimes it could be considered to prevent the intention of permanence in the lease. Some examples of provisions in a lease that would support that an installation is permanent and would therefore qualify as a capital improvement would be if it says something like immediately upon installation, an improvement would be considered to be, the title would be transferred to the lessor, or that the addition or alteration becomes part of and remains part of the property upon termination of the lease. And then these provisions here that are listed on this slide, they don't prevent the intention of permanence, but they don't really support it either. They're kind of in between. So if the lease were to say that it grants the lessor the right to require removal of the improvement, but it doesn't say that it must be removed, that doesn't really affect it either way. Same with a provision in the lease that states that the improvement becomes property of the lessor upon expiration of the lease, meaning they can do with it what they want after the tenant moves out. So if the lease doesn't say either way, whether something is or isn't permanent, then we would turn to the nature of the installation. When I was an auditor, we would review the lease document, and if it didn't say either way, then we were instructed to look at, well, what was the job that was being performed? So for the lease wording, if it were to include terms like it needs to be restored to its original condition upon termination of the lease, or the property that is being installed or the improvements being made is actually a rental from another party that would be removed upon termination of the lease, that would prevent the installation from being intended to be permanent, and it would make it taxable. So here's an example of language where the wording in the lease supports the installation being permanent. So the building, the operator of the building installs a new storefront on the building. And the lease says that the improvement is owned by the lessor right after installation, and it becomes part of the premises, remains there after the lease is terminated. So this wording in this lease would support that the work is permanent and it would be an exempt capital improvement. This example here also supports that it is an exempt capital improvement based on the nature of the work. So in this example, the lease may not have said specifically that this work would or wouldn't have to be removed, but because this is installing water supply pipes that run underground from the city water main, this is something that obviously wouldn't be removed upon termination of the lease. So this would be an exempt capital improvement here. And then in this example, the tenant is building a closet and installs kitchen cabinets. The lease requires that the premises be restored to their original condition when the lease is terminated. So they have to remove the closet and the cabinets that they installed. And because the lease says that, the installations aren't considered to be permanent, and this work doesn't qualify as a capital improvement and would be taxable.
All right, we have a question that came in. I'm just going to bring you guys for a second. Question came in from Jim. What do I do if I didn't charge tax on a leasehold improvement contract?
If you did not charge tax on a leasehold improvement contract?
Yes.
Well, it would depend on the nature of the work and the wording in the lease. So are you saying that, so if you found that the lease agreement said that the installation that you made should be removed upon the tenant vacating the premises, so it would be taxable work, and you didn't charge it, then you would need to remit the tax on your sales and use tax return.
I guess, Kaitlin, from a practical perspective, though, I know I've dealt with this a few times, and, I think a lot of the time, our auditor is like specifically looking at capital improvement work to see, did you do this for an owner of the building, or did you do this for, someone who has a leasehold?
I think it would depend on the auditor, but generally we were trained to look for that.
Okay. I mean, I've had instances where we dealt with that before, we used to do some work for grocery stores, right? And, if you're doing a refrigeration contract or you're doing some electrical, it might say it has to be restored to the original condition of the premises. But in a lot of cases, the auditor will even say, well, what else is going to go in there but another grocery store? So I think in some cases we kind of made it a split. We maybe said 60-30 or, 60-40 or 70-30 taxable exempt. So, I think it's something where, contractors probably just need to be more careful, at the outset of the construction project and kind of understand, am I doing this for the owner, or is this really a leasehold where I can get myself jammed up if I don't understand, the nature of the agreement?
Right, yep.
Okay.
That sounds reasonable.
Always some flexibility there with the state.
Yeah, and I mean, the lessor probably would be, or the lessee actually could be providing an exemption certificate, a capital improvement certificate. So even if the lease terms didn't necessarily agree that it was a capital improvement that would be permanent, if they provided a certificate to you certifying that this is a capital improvement, that would also help support be exempt work.
Good, okay.
Thanks, guys. If anybody else has questions, just pop them into the question section. Otherwise, we're going to keep moving forward.
Okay, now we're moving on to repairs to real property. So New York State taxes maintaining, servicing, or repairing real property. And it defines it as any activities that relate to keeping real or personal property in a condition of fitness, efficiency, readiness, or safety, or restoring it to such condition. Some examples of these services on a building would be painting, repair and remodel, servicing the grounds, landscaping, tree removal and trimming, and garbage removal, also cleaning and janitorial services as well. So if the services don't specifically qualify as capital improvements where they met that three-pronged test that Tom talked about earlier, then they will get treated as a taxable repair. Repair and maintenance to real property is kind of broad, and it basically includes any services that we can't justify an exemption for. So restoring land to an original condition, that doesn't qualify for a capital improvement unless it's being done as part of a larger project that qualifies as a capital improvement. But if it's just done on its own, then it doesn't qualify and it would be taxable. The imposition of tax on services performed on real property depends on the end result of the service. If the end result is repair and maintenance, then it would be taxable. If the end result is a capital improvement, then the services included in that project would not be taxable.
You know, Kaitlin, I think that's similar to what I was talking about earlier, where, you know, with the gas station, if you're pulling out the tanks, you know, from the gas station, and then you're just filling that with dirt and leaving it, that's a repair. You're just restoring that land to its original condition. The end result's a repair and maintenance. So then let's say you're gonna build a new structure there, you're gonna build a store, you're gonna build a building. Then in that case, your end result's a capital improvement. So then that pulling out of the tanks would not be subject to tax because it would be part of the capital improvement job, the end result.
Yes.
Okay.
Yep.
Perfect.
Perfect example, thank you. So on repairs to real property, we've already talked about how the contractor pays tax when they purchase materials. When they use those materials in a job that ends up being a taxable repair job, meaning when they bill the customer for the job, they're going to be charging tax, they're eligible to take a credit for sales and for the tax that was paid on materials. This would be done on the sales and use tax return. There's an area for taking a credit. So here are some examples of what are considered repairs to real property. This would be taxable work. So we've got installation of carpet, vinyl floor covering, and this is something that Tom had kind of touched on earlier. Carpeting and flooring can be a little bit weird. For it to qualify as capital improvement, it would have to be the initial floor covering in the building. If it's been more than 6 months after the building has been completed, then the installation of those items would not qualify as capital improvements, and they would be taxable repairs. Repair and maintenance of partial replacement of flooring. So say your roof leaked in your living room and it got a section of the floor wet, wood flooring perhaps got that wet and then had to be ripped up and replaced. If you're only doing a section of it, that would be a taxable repair job. Repair of lighting fixtures, repair of electrical components, or replacement of small electrical components would be considered repair and maintenance. And then repair of pipes, sprinklers, plumbing, anything that is like a small replacement of like a piece of tubing or something like that that wouldn't be replacing like an entire section would be considered a taxable repair job. Tom kind of already touched on painting and repainting because it is also one of those weird things where it kind of depends on the extent of the painting. So if it was like you did an entire remodel and you were painting walls that were newly placed there for the first time, that would be considered an exempt capital improvement. But if you were patching a hole in the wall and then you had to repaint over that section, that would be a taxable repair. Lawn maintenance, we kind of already talked about as well, would be taxable. And then asbestos removal, that follows whether the job is a repair and maintenance work or if it's a capital improvement overall. So if that asbestos replacement or asbestos removal, I'm sorry, was done in preparation of a larger project that did qualify as a capital improvement, then it would be considered part of the exempt capital improvement. Here we have an example of how the billing might look on a repair and maintenance job. So the contractor has been hired to perform a taxable job to repaint a living room. They purchase paint for $50 and pay tax on it of $4. The total is $54. So on the bill to the customer, you would mark up the paint. It includes the tax maybe that you paid plus an additional markup in there. You'd also charge them for labor, and then you would charge tax on the entire bill to the customer. So you're charging $710.10, including that tax of $52.60. So then, because you used the paint in a taxable repair job, you would be eligible to take a credit for the $4 in tax that you paid when you bought the paint.
Okay, great example. I do want to do one more poll question. Launch it now. Are you taking credits on your returns for sales tax paid on material used in repair and maintenance jobs? So Tom, I'm going to let you guess the percentages this time. Where do you think it's going to come in?
I think it's probably going to be more towards no,
Okay.
based on my experience with my clients, but we always get a lot of questions on that. And I think some people just, it's not worth their time to do, so.
Right. Okay, well, a couple people are still voting. Let's see where this group comes in at. All right, I'm going to close this out in 3, 2, 1. And 53% no, so we're kind of right on target there.
Yeah, I'm not surprised by the results, so.
Okay. All right, I want to keep us moving and on track. We have about 10 more minutes to finish up the presentation and get any questions answered that we still have coming in, so.
Yeah, so just a couple other issues that we typically see with a lot of our clients who are contractors is, performing work for government entities or exempt organizations. Your charges to a government entity and exempt org are not going to be subject to sales tax, whether it's a capital improvement or any type of repair or maintenance to the real property. And at the same time, any of the materials that you're purchasing, your building materials, those will not be taxable either. So that's different than what we've talked about. And a contractor, when they're doing a job for an exempt entity, can use Form ST 120.1. It's the contractor exempt purchase certificate. It's not the ST 120, the typical resale certificate, it's the 120.1. And on that, you have to list, your name and address, your customer's name and address. You have to provide your certificate of authority number, because in order to use ST 120.1, you do need to be registered to collect sales tax in New York State. And then you have to provide some information about the job itself, its location, whom the project is with, if it's what the prime contract is, if you're a sub and whatnot. And then you would typically check box A on it that you're purchasing tangible personal property that's to be used in a building or structure for an exempt organization or a governmental entity. So what are some examples of these exempt entities? Typically New York State, any of its agencies, instrumentalities, subdivisions. So that could be anything from the state itself, a county, a town, a school district, anything like that. Religious, charitable, scientific, educational corporations. So typically your 501c3 type exempt organizations, posts or organizations of, former members of the armed forces, and then any types of Indian nations or tribes residing in New York State, as long as the work being done is located on a qualified reservation. So that would be your typical types of exempt entities. And then just a reminder with this, we talked about that ST 120.1, that has to be for your materials that are incorporated into the project. You cannot take a credit for what we would call tools of the trade, which are not incorporated into the real property. These are things that you're using or consuming in the performance of the service. So no machinery and equipment, including rentals, repair parts, no office supplies, tools, anything like that. That's something that's on your own. That's you're using and consuming that. So that would be considered taxable. Anything not incorporated into the real property, you cannot use an ST 120.1 for. And then contractor exempt documentation. There is some, various forms and whatnot that you would be able to use. It's interesting when it comes to a federal or state government entity, there is no real form that you would get from them. A signed purchase order is really proof of the exempt status for that contract. As long as it identifies the exempt governmental entity on it, then that's considered sufficient. New York has, what do they call them? Status letters or something, entity letters, I think, Kaitlin, that they used to send, or you can get if you're an exempt government agency that just kind of identifies it.
Yeah, it's like a letter. It's not really a form. It's like some kind of packaged letter that they use, like a template.
Yep.
And then they just insert the organization's name.
Yep. That's sufficient too. That works too in that case. And then when it comes to other exempt organizations such as 501c3s, you can just collect their ST 119.1 exempt organization certificate. That would be proof that you're dealing with an exempt organization for purposes of sales and use tax. That's something you would also want to pass along to all the subcontractors on the job. If you're, the prime contractor in this case, if you're the sub, I would make sure that you're getting some proof from the prime that, this job is exempt, whether it's the ST 119.1, copy of the government purchase order, that, exempt, that entity letter, anything like that. And then I think there's DTF 801 is the form you would get if it's work being performed on a qualified reservation. So those are the documentation. That's the documentation you would want to get, in these cases. And then just a couple other interesting things here. Contractors acting as a retailer. So I think Kaitlin might have touched on this before, but if a contractor is building a house and the homeowner wants you to arrange for the purchase of a washer or dryer, well, that's not a building material, right? And that's something that you're going to charge them tax for on the installation because it remains tangible personal property. You can use that ST 120.1, that contractor exempt purchase certificate, and then you can buy it tax-free from Lowe's or Home Depot or Orville's or whatnot, and then just charge tax, on the cost of that property, plus the installation when you bill the customer. Same thing, I think we see that every once in a while, where contractors might be selling something, that they're not installing, whether it's lighting fixtures or something like that. You can use the ST 120.1 to purchase those materials. And then, a contractor, a retailer acting like a contractor. So I think everyone is knows you can go to Lowe's, you can go to Home Depot, stores like that, and you can buy a garage door opener. You can buy a hot water heater from them. And in that case, you could also arrange for them to do the installation. In that case, that retailer is acting like a contractor. So they're not going to charge you sales tax on, that garage door opener or that hot water heater. It's going to be treated like a capital improvement in that case, where you would fill out an ST 124, and then there's going to charge you the cost of, the labor and the materials, and they're going to, pay use tax themselves on, the value of the part or the TPP that they're installing for you. That also works too, we see that with fabricator contractors. We see that a lot, where if you're a fabricator, maybe you're fabricating duct work that you're going to install, you're fabricating, I don't know, steel or something, you're not considered, you're considered a contractor as well. So you're going to have to end up paying use tax on the value of the materials that you're installing that result in a capital improvement project there. And then finally, just, one other thing to note, other contractor purchases such as, waste removal services, there's a lot of construction debris from the job site that the contractor needs, to get hauled off, temporary facilities, whether it's maybe scaffolding or a hoisting system, electrical or plumbing, the taxability of that kind of depends on the end result of the job, right? Like we've talked about that before. So if the end result of that job is a capital improvement, then the contractor, doesn't need to charge tax on that. If the end result's repair and maintenance, and, the flip results where you would be charging tax on those services. So just one other thing to note with that. I think that brings us to a close, Carolyn.
All right, so as you guys are reviewing any questions that have come in, I'm gonna launch our final poll. Based on what you learned today, how are you feeling? Hopefully nobody's gonna give up, but maybe some people are. Hopefully people are still not confused, but you never know. Voting, we do have a couple questions coming in, so we want to save time for them. I am going to close this poll out in 3, 2, 1. I'll share that just real quick. There are most people are in good shape and they're obviously going to be on the right track, so that's awesome. A couple people that will have some conversations with offline and see if they need any help. So just gonna move it over to questions. Looks like there's one that came in from Deborah, kind of a statement and a question in here. Honestly, too scared to take the credit, not sure how to document fully and on the sales tax form. So not sure if Tom or Kaitlin, which one of you wants this?
Yeah, no, I mean, it can be a little confusing, to do that, and it does require you to complete, I think, the AU11, the refund claim form when you're, taking those credits. And, the state's got to want to see a detailed schedule, right, Carol? Right, Kaitlin, on that?
Yeah, there has to be documentation supporting the amount of credit that you took. And commonly, what we would look for when I was doing audits is if materials had been purchased for a specific job, sometimes the invoice would say like the materials shipped to, and then it would give like the name of the project. And we would know that those were specifically used for that project and then it was easy to document an exemption that way. But in the case of materials that were purchased in bulk and then used across however many jobs, they could have been used for some repair jobs, they could have been used for some capital improvement jobs. The documentation that we would have looked for there is material cost sheets or job cost sheets that list out like each of the materials that were used on the job. And then also having the purchase invoices for where you purchased the materials in connection with those job cost sheets is what we would look at to see if they were reasonable.
I think a lot of people may struggle with the fact that, their inventory system, maybe that whole system of, allocating where the materials go to. I think that if you have a strong system with that, it's probably a lot easier to take the credit. If you don't, then I think it's going to be a little bit more difficult. And then actually kind of weighing, the cost benefit there, like how much am I going to get back? Is it really worth my time to do and track all this?
Great, thanks, guys. Deborah, I hope we answered that for you. If not, let us know. There's one more, another one that just popped in here. How do I claim a credit for sales tax paid on materials used in repair and maintenance job where I collected tax?
Yeah, I think it's similar to what we were just talking about. It's really, like Kaitlin said, you've got to claim it, on the return. As a credit to purchases subject to tax. When you fill out your sales tax return, it has, those lines when you go into each jurisdiction, and you would just put that credit amount in there, depending on the jurisdiction where you use those materials. And then it would generate what we call an AU11, a refund claim form, and you would have to attach to that, AU11 online, like upload like a schedule and, copies of copies of invoices. Yes, yeah, maybe, depends.
Depends. If there were those ones that I was talking about where you specifically purchased materials for a job, maybe that would be helpful to attach those. But if it was the bulk purchases where you're allocating certain materials to jobs, maybe just having those on hand in case the auditor wanted to look at them would be helpful, but I don't think you would need to send each one of those.
Yeah, and I think in a lot of cases that would be a refund unit, a desk audit person would kind of handle that. So that might be a case where they might wanted to see a couple, just to verify that, hey, the tax was paid.
Great, thank you, guys. I don't want to keep people much past, but I do. Pat just submitted a question. I'm in Canada. Where can I get a refund form?
A refund for what, I guess I would.
Refund form. Where do they get the form? Were those the linkables?
No, you would get an AU11 form you can find online with New York State, or if you're just claiming those credits as part of your sales tax return, it kind of pops up automatically when you fill out, any purchases subject to credits on purchases or credits on sales. You have to complete the AU11. Otherwise, you can get an AU11 online on the state's website, and you can either, do it electronically or send in a paper form for that. And, a lot of the guidance that we spoke about today, Publication 862, as well as a number of other tax bulletins, are online on the New York State website. If you just Google new NY sales tax contractor, a couple of the top headings that would come up, like contractor, repair person. If you click on that, there's going to be a whole list of, bulletins and other publications that you can refer to, for additional guidance.
Great, thank you. If you can't find it, Pat, let me know. Reach out directly to one of our experts. I'm sure they can help you or send you the link. I do want to wrap up today, just letting everybody know that our April webinar, the topic will be captive insurance, and our main topic will be mergers and acquisitions, market trends, and